On behalf of Biz Talk Today TV and CrossCheck Media, welcome everyone to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I'm joined by my friend and co-host, Tobin Smith, out in sunny and spectacular Scottsdale, Arizona.
Finally, I get some props on Scottsdale. Finally.
Absolutely. Well, hey, you're the mayor of Scottsdale. We have to give you props on that one. But with us today is who we consider one of our best guests ever on Buy, Hold, Sell, and that is Victoria Fernandez, who is joining us again. She is the Chief Market Strategist from Crossmark Global Investments down in Houston, Texas. Victoria, thank you so much for joining us today on Buy, Hold, Sell.
My pleasure, guys.
Absolutely. Well, listen, we got to start talking about this market. You have your firm, you and the entire firm, are really talking about how the investment public is thinking that we're going to have over 115, maybe 115 basis points in Fed cuts this year. We only have a few months to go, a couple of meetings left. But you actually are trying to simmer that down. You're talking about a 25 basis point cut. But what do you think about this market? Because if we only get 25 basis points, wouldn't that mean a sell-off for stocks?
Victoria, I just want to make a point that Todd doesn't really realize that he has a microphone and he doesn't have to yell across the United States. So I apologize.
He's very excited.
I apologize for your ear damage. I don't know what to do about it.
That's okay. I'm from Texas. We talk loud. It's all good.
That's true.
But looking at the market,
okay,
you're right. The market is pricing in about 4 cuts from now to the end of the year. I really don't think that's going to happen. You have this argument that the Fed should have cut in July. They're behind the curve. They need to catch up. Neutral rates at 3, maybe 3.25. They have this long way to go. All these arguments that say they should go 50. But I say, okay, take a step back. Look at the other side of that coin. A lot of people have this bias of just looking at the data that feeds their opinion. And I agree that the economy is weakening and the Fed needs to cut rates. But then I look and say, wait a minute, Atlanta Fed GDP now is at 3.5%.
Yeah.
You're telling me productivity is continuing to get better. The labor market is weakening, but it's not falling off a cliff at this point. So why do we need to go 50 basis points? Why do we need 100 basis points over the next couple of months, especially when we have an election right in the middle? So we know there's going to be volatility.
Yeah.
Let some of that, kind of work its way through, and then let's regroup in December, see what we need to do at that point in time. I actually feel like the market will probably weaken more in 2025 when earnings start to decline, and that's when the Fed might pick up the pace a little bit. I don't think we have to do it right now and just, kind of stir the pot even more than everything that's going on both here and then all the geopolitical events as well.
Yeah,
it makes a lot of sense.
Yeah, Victoria, I concur. I mean, there's a lot of indicators that I follow. I don't think some of these jugheads do. But one of them happens to be just how many job openings and how many people are looking for a job.
That's right.
And right now we're at one of the higher levels you'll ever see. And it's impossible to have a recession or a stagflation if you have this discontinuity. Number one. Number two, I don't know if you noticed down in Houston, hey, that oil's down to $66 a barrel.
Yes.
And if the major bitch and whine of people is that, my gas, listen, I drive an SUV. When it was $6 a gallon and $5 a gallon, I had to use a second loan. But kidding. But the other issue was that the actual inflation print we're going to see, and we get all the numbers sort of up front and then sort of extrapolate. Mm-hmm. We're going to see a lower CPI. It's going absolutely in the right direction. We really basically have more risk of disinflation at this point. You're totally right that the election, is going to throw some zingers in here, but it always does. And by the way, September is the S word. It's always been the T month. That's just, it's for all the sort of reasons. And then on top of this, you throw on Ally Bank and some of these reports this morning about how that 50% lower cohort, we got this economy and the top 50% is doing okay. The top 25% is doing 72% of all discretionary spending. So that's no problem there. But when you see
Yeah.
Ally, which is just an auto lender, when you see them have a default rate and a late pay rate up almost 9%, that's a warning signal at the low end. All I try to emphasize every week for the last 16 years that we've been doing this show is that the U.S. economy is driven by the top 25%. The top 25% is doing great.
Yeah.
Look, it's one of the reasons, I've had a conversation with many people around the retail earnings that just wrapped up. And everyone said, look, the consumer's doing great. Look at Walmart. And I said, but Walmart's doing better because the higher end consumer moved down and is shopping at Walmart. That's why Walmart's doing better. We're not seeing the same thing with Family Dollar or Dollar Tree.
Or Dollar Tree. I was at Walmart on Saturday, only because I couldn't get to Costco because there's an auto accident. I rolled into Walmart. I had not been in a Walmart in a long time. OMG. It was packed. And this is like on a Sunday. And, you're exactly right that you can see it on their multiples that someone's coming down from my area and going down to that area at Walmart because guess what? It really is a lot cheaper, A. And then B, the food choices they have now are significantly different. You used to have bologna sandwiches out there. Now they've got really a great.
They have everything, and food is actually about a third of the revenue for Walmart. So people, when you've got groceries that are 25-30% higher at your grocery store than where they were a couple of years ago, I mean, why not go to Walmart, buy a Walmart brand versus a name brand, and that's what people are doing. So they're still spending. It's just they're spending in different places. And I do think we have to watch, though, household balance sheets. We saw revolving credit go up last month about $10 billion. So, are they spending more on their credit cards? It kind of leads to what I was saying, where I think we'll see more of a pullback in the market, more of a declining economy in 2025 than I think we will right now.
Yeah, I will say this. There was a lot of BMWs and Mercedes in that parking lot at Walmart.
So you did bring up a number, because reading your notes, there were a number of headwinds. I mean, you're talking about the Challenger number coming out, used car sales, I believe, were down. And so there's a number of factors right now, a number of headwinds that investors and Americans need to worry about going forward. But wouldn't that then justify a Fed rate cut? And perhaps they are looking ahead, whereas they're being more proactive than reactive. What are your thoughts?
Yeah, I mean, I do think the Fed needs to cut rates. And so these cracks that we're seeing in the market, like you said, vehicle sales are down, Challenger gray layoffs are up some. We've seen new orders in manufacturing, but my goodness, manufacturing has been doing poorly for, 18 months now. One of the things that I think we should be concerned about is you look at the housing industry. Okay, we've had rates come down, but we're not seeing home sales really pick up that much. So there are cracks in this market, but they're small cracks. They're not these huge cracks that say, oh my goodness, we need to do like a Volcker moment and go in and do these huge cuts. I don't think
don't say Volcker. I have PTSD.
we won't say that word. But I just don't think it's telling us we need to do that. And I do believe that, some of the inflation numbers coming down are purely because, Toby, what you were saying around gas, right? And oil. What those prices, that's very volatile. And so we could see those numbers go up a little bit, which means inflation might stall some. I think the Fed is going to be a little cautious in cutting too quickly and really kind of fanning these flames of, purchasing by consumer, because like we said, they're out there buying, and it's going to cause them problems 6, 9, 12 months down the road. But I don't think the Fed wants to encourage that to the point of detriment. So this is why I think they will go slow. Should they start cutting? Absolutely. There are reasons, but do we need to do a 50 basis point cut? I think it would spook some people if they did a 50 basis point cut. I think if they only do 25, the market might not be happy with that either. They are in really kind of a lose-lose situation.
So the market is a child, in other words. Is that what you're saying?
It's a toddler. It is. It is absolutely a toddler.
Yeah,
that's very funny.
Well, let's also, the interest rates are affecting this manufacturing business more than I think people know. Auto sales are down. Why? The average monthly payment on a new car is $798 according to
Wow.
the guys today. So, you know, that's $798 after tax. So let's call that, you know, $1,100 or $1,200 cash money. You know, everybody's leasing the EVs now because nobody wants the EVs. You get a great deal, Todd, in an EV. You can lease one out here in Phoenix for a Tesla for $280 a month.
Hey, I'm in Texas. We're not driving EVs out here. We got the big SUVs. We got the gas guzzlers going.
I haven't even got into the F-150 price.
I know.
I mean, well, I believe the number is 18% of all vehicles sold in the United States are an F-150 or a Ram truck or a GMC truck, right? And in Texas, it's 36% because we do everything bigger in Texas, right?
We do indeed.
So then the home building, OMG, if the average price, other than, you know, way out in Prairie, Texas,
right,
is $780,000 for an entry home, that mortgage payment, excuse me, is also about $3,900 a month. So there is a just huge wall between what's affordable for the average family, the average working two, you know, husband and wife working, single, having a much rougher time, and then the top 25%. We're looking at our stock portfolios, going, well, geez, I'm going to buy another house in La Jolla, and that's the dynamic we have in our economy. So I'm watching loan defaults. I'm watching Ally because they do all these things. I'm not watching American Express. American Express doesn't have a problem with loan defaults or late payment. So I'm looking at the bottom 60% of households by income.
Okay.
Well, and you know, there's this bifurcation you're talking about.
Well, you get a word point for bifurcation.
You like that word?
I love that word.
There is for the consumer, but there also is, like, when you look at the labor market. So one of the things that we watch is not just looking at the jobs themselves, the payroll numbers, but looking at cyclical jobs versus non-cyclical jobs, right? And cyclical jobs are 78% of what's going on. That's payrolls minus government, healthcare, you know, those areas that don't change along with the economy.
That is an interesting number.
Yeah, and so the cyclical jobs make up the majority, and that is declining. It's the non-cyclical that have been supportive of payrolls and a little bit of construction as well. I don't want to completely say there's no cyclical components there, but education, healthcare, and government have been what's supportive. That's not strong breath underneath your labor market. So as you talk about people not being able to afford things, and it's those people that are probably in some of those lower income jobs that are losing their jobs, it's going to make it even more difficult. It feeds into, and I know we'll talk about it a little bit later, you know, looking at kind of the discretionary part of the market versus other parts of the market and where you want to put your money to work.
Yeah, there's no question, Todd. The stock market, right, is supposed to look forward, right? It's supposed to be a discounting mechanism on what's going forward. I can show you, I'm like the economist. On this hand, I can show you 5 reasons why, we could be in a mild recession. I can show you 5 reasons on the other hand why, spending is strong. Remember, let's not forget about the 5,000 boomers who turn either 65 or 70 up until the year 32, who are retiring with money for the most part, and they're not working. So those jobs need to be filled. So there's literally 6 to 10 different variables that support, hurt themselves, and that's why it's confusing for people. I mean, I get it. It's
why there's so much uncertainty on the macro part of this market, and why you have people like me saying, let's just start at 25, and you have other people saying, no, we need 50, basis point cut. Let's go and do 100 basis points. There's just too much uncertainty, and there's going to be more of it to come, in my opinion.
I heard someone say today, going 50 basis point is like kissing on the first date. Let's just hold hands.
You're not supposed to do that. That's right.
You're not supposed to do that. It's
any young girls listening, don't do that. Yeah.
Well, I'm just doing this for Todd's benefit. Okay. But
thank you. I knew that was coming. So I do, before we go to the break though, Victoria, I do want to ask you real quick. We were talking about oil a little bit ago and how you can see oil prices rising. The hurricane down there, you're right there front and center. Hurricane Francine is expected to be a Cat 2 storm when it goes right into Texas. Are there any rigs that are in trouble or maybe in the danger zone, even Galveston?
So it's moving a little bit east right now. It's funny. I'm looking out my window here and seeing the rain start to fall right now. So it's moving a little bit east, going more towards Louisiana, which unfortunately, is where we have a lot of refineries and a lot of rigs right there in the Gulf as well. So I know that they all, take precautions to what's going on. It's a pretty good sized storm. They are saying it could develop up into a Cat 2 by tomorrow morning. So definitely there's some issues around that. If supply is interrupted, we could obviously the price go higher.
Yeah.
What we've seen as of late is the demand component, especially when you look at Asia, declining demand has allowed prices to go down, even with geopolitical events going on. We could see a short-term pop this week in prices if there is some disruption from the hurricane.
Yeah, I mean, and let's also, if you look at the gasoline in storage and oil in storage, I mean, we've got multiple weeks because they start putting oil, the gasoline in those storage caverns in May, June, July to get into the storm season. So I mean, I wouldn't worry. We don't make judgments on blips. We make judgments on trends.
Right. And this would be a very short blip if we saw it. It would not be something that I would change a position in a portfolio over.
Yeah. Although I would say this, I always buy Generac, the generation company. I always buy the stock before any hurricane or tornado.
Right before hurricane season.
Right before. I made enough to, buy a Generac just by buying the call options. In my new house, I am installing a Generac, by the way.
Very smart.
But purely because it's like now I'm hypnotized by it. That if the power goes out, I'm not going to lose my television and my football.
Okay. There you go. And you have people doing power walls as well now.
Oh yeah.
Tesla and other makers too. So different options out there.
Interesting. I never really thought of that, but yeah, it's a great idea. But yeah, we'll have to talk about that as well. But listen, let's leave it on that block, guys, because coming up next, we're going to ask Victoria all about her favorite sectors. There's so many to choose from, but there might be some that you might want to stay away from. And we're going to break it all down for you. So with us today is Victoria Fernandez. She is the Chief Market Strategist over at Crossmark Global down in Houston, Texas. And we'll be right back after the break. Please stay with us.
Buy, hold, sell, brought to you by CrossCheck Management.
What does it mean to be a leader?
It's taking my first solo flight.
At the University of North Dakota, we lead our own way.
Welcome back to Buy, Hold, Sell. Well, with us today is Victoria Fernandez. She is the Chief Market Strategist at Crossmark Global Investments down in Houston, Texas. And Victoria, when we left off at the last break, last block, we were talking about oil. We were getting into that a little bit as far as how the hurricane may impact oil prices. But I've noticed some other sectors that you and the firm are interested in, one of which is financials. I would think that with interest rates potentially moving lower, that might be an area you would want to stay away from. But what do you think?
Yeah, so we actually like financials and we've liked them all year because of the fact that you're having a yield curve that is now normalizing. So that will be positive for the banks. You also how much have we talked about the volatility that we think or the uncertainty in the markets? When it's that type of a market, you want companies that have strong balance sheets, good cash flows, good management teams. Those are the banks to us, those larger banks. We're not doing as much in the regional space, but a JP Morgan, a Bank of America, both names that we own and our strategies, they've actually pulled back over the last couple of days. So it's actually an opportunity probably for someone if you don't have exposure there to go in, but they're solid companies, well run. And now with the yield curve normalizing a little bit, it gives them an opportunity to go back to lending and borrowing the right way.
Well, okay, and to explain the yield curve to our viewers and listeners who maybe don't speak finance.
Yeah, so when you look at the yield curve, basically the yield that treasuries are producing from T-bills, which are very short, 30-day Treasury bills, all the way out to like a 30-year, a bond that's maturing in 30 years. A bank is loaning at one end of that curve, right? And borrowing at the other. So you want the curve to be in a position to where they're making money on that trade, where they are lending at more than what they're borrowing. And that's what we are now starting to see again for the banks. It hasn't been that way for a while. That affects the income of the banks. Now that the yield curve is getting back in the position that it typically is, that's going to be positive for the banks.
Well, Mr. Positive, Jamie Dimon this morning was a classic humbug.
Yes, he usually is.
On the at the bank conference. But I'll tell you, you've been right to be in the finances because the market has been anticipating lower rates. All right, so I give you kudos to that. I closed out most of the financial stuff that we had last week simply because, you made stupid money in a bank. I mean, I'm like B of A's up like 55%. So I might get nosebleeds there. But the other thing is that like Ally Bank coming in today. Look at Goldman Sachs. They come out and they said, "Jeepers, our trading volumes are down." It's down 9%. So just like AI was priced for stupid, ridiculous, valuations and perfection of perfection. Mm-hmm. The banks got such a run up because it was just an easy trade to make. I mean, you were smart to do it, but it was their interest rates are going down, blah blah blah. And so I'm out of them right now. I mean, I would want, if I got a bigger pullback, I'd be interested. But I'm
right. And one of the things that we say is don't be greedy, right? So if you've made money on these trades, take a little bit off the table. You don't have to take all of it if you don't want to. We still have some exposure there, but there's nothing wrong with taking money off the table. We did it in the tech trade for the first 4 or 5 months of the year, and that gave us money on the side to do some of these other elements that we're looking at.
Yeah, I mean, there's no question that we've been reinvesting SMCI and NVIDIA and
absolutely
Invertive, VRT, etc. I just put a newsletter out to our subscribers, and I went through the 24 times I've said since January of this year. You realize that when a stock goes from $58 SMCI to $1,200 in 9 months, you understand that that's a bubble. That's a mania. That's a FOMO, fear of missing out mania. And it's all being purchased by algorithmic, momentum buyers. At some point, when they reverse, all those people say bye-bye because they're algorithms. They're not human.
And we saw, a lot of that unwind at the beginning of August, because of the yen carry trade and all those technical components of it. But you saw people having to go in and sell some of those names, and people had losses on them. They should have been trimming them all year, like you said, when they were at those higher prices, to give you some room to go into other areas.
Well, the rule
you don't have to go out completely, but you need to get trim down those positions.
The rule I preach to do-it-yourself investors on an SMCI or an NVIDIA run is, first off, take your original money out. Take that capital out, okay? Because there's no tax element there. That's your cost-based. Then in the case of SMCI, take 100% return on that money you had in. And then if it goes up again, take another 100% on your money. So now you've made 200% in a stock market that normally goes up 10% a year.
Right.
You've just taken out 20, 30, 50 years of gains. And people won't do it if it's in a taxable account because I'm going to have to pay some taxes. Well, look at yourself now. You were sitting on, I have people who invest in our private placements who are putting hundred thousands of dollars into our private placements. Because they had profits to do it, and they were able to, actually be liquid and take advantage of things. So it's just a lesson learned. I only learned that lesson the hard way. Every lesson I've learned, I don't know about you, young lady, but it's always been 7 figures. Yeah. And the first one was the beginning in 98, 99, and rolling into 2000, everybody has PTSD. Dan Niles, I was talking to yesterday.
Yeah.
And he was my guy at Montgomery Securities in that time. And he has the same thing. He's got PTSD bad from being, buy the dip on one of my favorite companies, Micro Strategy, that went from $300, down to 10.
You can kind of think of it as like, if you're in Vegas, I'm not a big gambler. I used to be married. My husband at the time loved to play blackjack. Well, I would go by every now and then, take some of his chips away.
Yes, that's a great analogy.
So that we make sure we didn't lose a lot of money. I mean, it's the same concept. A little bit, take off the table at a time, take off what you started with and play with your winnings. Same concept.
I'm gonna use that in my next newsletter, and I'm gonna give you credit for that, Victoria.
Okay.
It's much better. It's much better than mine, which is at some point on Thanksgiving dinner, once you've had the third helping, you feel like you're gonna puke, right? You need a digestion period. In this case, like 3 days.
There you go.
So, once you're stuffed with NVIDIA or SMCI or other ones that are 20% of your portfolio, 30% of your portfolio, then you don't understand risk management. And most yourself investors just don't understand because they don't have the PTSD like old shits like me.
And you know what? It doesn't mean you have to get out of the tech space. A lot of people say, well, wait, I want tech. It's the AI boom. There's other opportunities. I mean, Oracle had a big run up because of their earnings yesterday, but look at some of the other names in the tech space that haven't had those run ups and that will still benefit over time. We have a long runway here for AI. It's not going to just end tomorrow. So find some that haven't had that huge bump up yet in price and build your portfolio, your tech exposure with those.
Yeah, or repurchase SMCI like I did, down 68%. I mean,
exactly.
Now selling at a forward price earnings ratio of like 9, and they've already pre-sold every container that they can, build and make through all this year. So that's the advantage then of having some liquidity. What if you're sitting there going, boy, I sure wish I would have sold that and now I could buy it 66, If you're going to actively manage your own funds, you have to actively manage your own funds. That's my message.
Right.
Very well put.
That is. And so another area that you've been focused on, though, at the firm is the staple sector, and especially the companies that are paying dividends. I mean, is there a certain threshold of a company, or are you just looking for rising dividends? I mean, ExxonMobil increases its dividend every quarter, but the stock really hasn't done very much either. So, I mean, are you just focused on the dividend side, or would you like to see that growth appreciation?
No, we want to see some growth in there as well. We like having the dividend component because it helps buffer some volatility, maybe in other areas of your portfolio. But, we're talking about a Fed rate cut. Well, historically, for about 6 months after the first rate cut, you've got financials, staples, even transportation stocks. These are the areas that tend to do well. And there's this leadership change going on in the market. We see the tech names coming back. They're actually getting ready to kind of trade under their relative low to the S&P from earlier in August. And you're seeing these other sectors we're talking about, financials, healthcare, staples, utilities. These are the areas that are starting to build some momentum. In the Staples sector, we would say look at some of the larger companies, though. Staples is we used the word bifurcated earlier. I'm going to use it again. Some of these sectors are bifurcated, and it's the larger ones that are doing well. So you look at a name, again, names we hold like a Colgate-Palmolive, like a Coca-Cola. You're getting dividends out of these. You're getting strong balance sheets. It's that whole concept of quality companies, especially during volatile market times. And so Staples is an area we think is smart to play for the next few quarters.
Yeah, I was just going to show Todd, this is very scientific. These are the 52-week highs from the last 3 days ago. McCormick Spices.
Oh,
Paul
from
Mall.
Baltimore.
Yes. You have to understand, even though he doesn't live in Baltimore anymore, his entire world is Baltimore.
Well, we won't talk about the Ravens, right?
We'll get into football in a moment.
No. That's for another show. I'm trying to support your point about is that Victoria, that if you're a money manager and you've seen the AI FOMO shoot up like that, and you're sitting on 10, 20 years of earnings in 9 months, then as a fiduciary, you should be arrested and flogged if you don't make the transition, because They're overbought. They're too expensive. They're priced for absolute perfection. Look at NVIDIA, knocks it out of the park, but you can't do any better than that. So that's when you then look, to your point, in the playbook. Okay, where's the safety trade? Where's the trade that hasn't done anything while essentially the AI world just sucked all the oxygen out of the room, and room being the market. And so that's just portfolio management. That's just portfolio management,
Right?
And
right.
risk management, more important.
Yeah. Victoria, I want to switch gears on one thing before we end the show. But and this isn't, we're not a show that talks about politics. We talk about finance. However, the policies from both candidates when it comes to corporate taxes, and clearly the Harris camp, they're talking about raising the corporate tax rate. And then with the Trump camp, they like to lower or keep them lower. So what are your thoughts? I mean, do you think Wall Street is really focused a lot on this election only because of the tax rates that we could be facing on the corporate side, or historically Wall Street kind of just takes a blind eye and doesn't worry about it? What are your thoughts?
Yeah, I don't think it's the only reason people are paying attention. I think they want to get their popcorn and sit back and have some entertainment. But when it comes to managing a portfolio and what the markets are doing around this election, I think there's some concern if we see a sweep from one party or the other. It doesn't matter which one, because there's more likelihood of these different kinds of policies actually going into place. I think what the market is hoping for, and actually what the market usually hopes for, is gridlock. More of the same, right? They like the gridlock because they know they're not going to get any huge tax raises. They know that there's not going to be huge policy shifts if there's gridlock. So if it looks like that's what's going to happen, I think the market will kind of work its way through it. Doesn't mean there won't be volatility. There will, because I have to say, I don't think anyone's going to wake up on November 6th and know who the president is. I wouldn't be surprised if we don't know. Let me say that. I wouldn't be surprised if we don't know who the president is when we wake up that morning.
Yeah.
And by the way, the Fed meeting starts
right
the next day, right? So there's a lot going on around the election that could cause some volatility. It's why I think the Fed will skip the November meeting. Or there are people that say there could be a lot of chaos going on and the Fed's just going to slide a cut right in there and no one will even notice. So you never know.
Todd, did you notice how her accent got a little more homespun when she talked about that?
It comes out every now and then on its own.
Well, Todd, irrespective of the politics, both sides, I'm more worried about the deficit spending. I mean, we're already at a point where we spend more on interest payments than we do, on defense, right?
Yep.
Donald Trump would cut taxes, great, all the supply side economics, and ran it up $4.1 trillion. Okay, the deficit. Okay, either side are guilty of increasing these deficits beyond and not cutting spending. So the whole idea of supply side was, if I cut those taxes, more businesses are going to grow, they're going to make better profits, and that's how we'll get those revenues back. Well, it didn't work out that way for a variety of reasons. On the other side, this threat of taking the capital gains rate up from 20% to 28%, also, then basically says, if it looked like the Dems are going to sweep, then you'd see some selling, unless it was something that would be starting on February, it would be enacted in, January 28th, whatever.
Yeah, taxing unrealized gains would cause some shifts, I'm sure, from people in the market if the Democrats swept. But also, to your point, this amount of issuance that we are going to have to see, Treasury issuance, in order to compensate for this deficit that we have, I mean, that's a huge concern for the markets because it's going to continue to push yields higher. And we already have the rating agencies that have come out and said, enough's enough. Y'all have got to get this under control, or we could downgrade you. And that's the last thing we need right now. So there's a lot of elements around that that could cause some chaos. Let's say.
Yeah. Let's not forget that the dollar plays in this thing as well.
Exactly.
And And the other thing is somehow Mr. Trump doesn't quite understand that if you charge 100% tariff on a product that's being imported in the United States, well, actually, yeah, the tariff goes to the government, but the 100% just gets paid by the actual consumer. So it would raise inflation.
He's balancing trade. You know that.
You're full of crap.
Oh, come on.
I mean, I'm just saying, forget about balancing trade. I'm saying that the consumer pays tariffs. The person who buys my $28 bottle of Italian wine, if there's 100% tariff on that, and I'm paying 50.
We can't have that.
We can't have that.
We can't have that.
Yeah.
You're right about that.
Consumers pay the tariffs. All right.
Yes, we got that. Consumers pay the tariff. And speaking of now, because obviously we're in football season, we have the most important question of the day for you, Victoria. Now that Stefon Diggs is down in Houston, how far will the Houston Texans go this year?
I'm not a fan if I don't say all the way, baby. I mean, we won our game this weekend. It was a great game. We want to see it continue. CJ Stroud is taking the reins.
Are you gonna pay him $240 million for 5 years?
I'm not gonna pay him that, but if the team can figure it out.
I got to tell you, Dak Prescott, I have not been impressed with for a long time. But as soon as he signed that contract, an hour before the game, he turned into a great quarterback, man. He didn't miss a pass.
It's amazing.
It's amazing.
I think I need to go talk to Bob down the hall about my pay. I'm not sure, but I think I'm a little underpaid compared to that.
Absolutely agree with that statement. Well, we're going to leave it there.
Every hike that he got was worth $730,000.
There you go.
Incredible.
I mean, it was mind-boggling.
Well, it was. I tell you, we'll see it all play out. What a wonderful thing! Everything, so much to look forward to this season. So many great players. It should be a lot of fun, that's for sure. So we're going to leave it there. We've covered everything today. We know the audience is getting a lot out of this as well. So, Victoria, thank you once again for joining us on Buy, Hold, Sell. We can't wait to have you back.
You're
My
the
pleasure.
best.
Can't wait to be back. Thanks,
You're
guys.
the best. I'm going to talk like this all day now, which is weird.
Love it.
Absolutely. Well, listen, on behalf of Victoria Fernandez and Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care.
Buy, Hold, Sell, brought to you by CrossCheck Management.